classic investing books preach a rule treated like gospel. A great company needs a return on equity, or ROE, consistently above 15%. If that number drops for 3 consecutive years, Wall Street analysts and automated algorithms will instantly throw the stock straight into the garbage. But consider a scenario where a company's ROE plunges from 20% down to 10%, and finally to a pitiful 5%. Over 3 years, the entire market hits panic sell, labeling the business as toxic. Contrast that with a company that suddenly posts a massive 50% ROE. Investors see that single high number and blindly rush in, desperate for a piece of the action. Investors often miss that a falling ratio can be the temporary byproduct of a company redirecting its profits into long-term infrastructure, while the high ROE winner might be masking a fragile capital structure. To survive in modern financial markets, you have to look past the top-line percentage and isolate the individual variables that actually drive it. A financial framework called DuPont analysis solves this, proving ROE is not a single solid metric. It's actually 3 separate business engines multiplying together. The first engine is the net profit margin. This measures pricing power, selling a premium product for vastly more than it costs to produce. The second engine is asset turnover. This measures operational volume. These companies operate on razor-thin margins, but move massive amounts of inventory at high speeds. The third engine is the equity multiplier, or financial leverage. This uses borrowed money to magnify returns on a small amount of shareholder capital. Identifying which of these 3 pieces is driving the growth is the only way to separate a high-performance business from a dangerous financial mirage. Let's see how a plunging ROE can signal a massive buying opportunity. Imagine you run a profitable local pizza shop and decide to expand and monopolize citywide delivery. To scale up, you stop paying out dividends. You retain every profit dollar and raise heavy outside investment to build a state-of-the-art central kitchen. Building a massive factory takes time. Adding cash and heavy equipment to your books makes total assets explode, but profits stay flat during construction. Mathematically, your return on equity is forced into a dive. However, when we examine the underlying data, profit margins remain rock solid. The new rising line is capital expenditure, aggressively buying equipment needed for future dominance. This drop in ROE represents the golden pit of capacity expansion, the moment a business scales its infrastructure to capture a huge market share. Now let's pivot to the dark side. Because the market rewards a high ROE, some executives use legal accounting maneuvers to artificially inflate the formula to secure multi-million-dollar bonuses. Trap number 1 is the buyback scam. A CEO takes out a massive corporate loan and uses that cash specifically to buy back and destroy the company's own stock. Watch the math in this fraction. Actual business profits drop because the company now pays interest on that new debt. But as the bottom equity denominator rapidly shrinks, the final ROE percentage is forced upward. Trap number 2 is the fire sale. A struggling business will sell off its core essential operating assets, like its high-end ovens, just to post a temporary one-time spike in profit. Trap number 3 is the shrinking denominator. If a company bleeds money for years, its equity base becomes so tiny that even a meager profit registers as a massive 50% return. In these scenarios, a soaring ROE is a corporate death rattle. It enriches management in the short term while leaving share eaters with a hollowed-out company. Ultimately, return on equity is a lagging indicator. Relying on it as a single surface-level metric makes an investor vulnerable to accounting manipulation. Success in modern markets requires the discipline to inspect the real financial engines beneath the ratios. That is the core philosophy of deep value intelligence. To explore advanced research and access our personal intelligent multi-agent, join the community at deepvalues.ai. You can also track the total market temperature by downloading the Buffett Indicator app from the Apple App Store. All content in this video is for educational purposes only and does not constitute financial advice. Investors must conduct their own due diligence. If you found this breakdown helpful, like the video and subscribe to our sister channel, Deep Values, for a deeper look at investing philosophy. See you next time.